Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Hello, everyone. Welcome to the New Barbarians podcast. Today is Monday, November 10th. The podcast will hit platforms later tonight. Our guest today is Rob Marsh, an old colleague of Mark's, a macro and AI expert. And today we're going to quickly go over a few of the recent events in the markets. I will touch on performance in the quant space, and then Mark will do his usual dashboard. The government shutdown continues. The BLS report of unemployment. I don't know if we came in with a surprise there or not, Mark, but I guess ADP estimated jobs created in the private sector suggest NFP growth remains subdued. So we're getting some nowcast information as well. And if Mark doesn't have that at his fingertips, I'll go back to my notes here. I did see something pretty interesting about earnings revisions having a big downward, like 4 standard deviation event last week. Volatility has been underperforming quite a bit, as has short interest. And then, I guess the value factors have been outperforming. I'll get those in the Sigma space, but earnings yield, return on equity, and dividend yield were all up like 4 or 5% last week. Yeah, earnings yield was up 5 Sigma. Dividend yield was up 5 Sigma. So big rallies in value.
Yep, definitely a rotation. All right, want me to jump in?
Sure, go for it.
All right, I'm going to not rip up the script, but shift a bit here. We have here today are 2 guys that attended my Credit Suisse salon dinners. As Rob just mentioned, a little wine, a little dinner, a little shop talk. And I love these dinners because you got to know people. And evidence is that, 10 plus years later, 2 of the guys at the dinners are here on this podcast, partying with Bill and remaining in contact with Rob. The reason I have this screen up instead of the regular scorecard to talk numbers is because Rob helped build this flow of funds model at Tudor, and he'll get into that a little later. And I mention it because today on Twitter and on a lot of the blogs, people are talking about the plumbing in the global market system. Liquidity is low. Rates are spiking on the overnight funds. There's not enough cash to feed the system, and that can and always does have a material impact on any capital allocation. So that's a near-term macro dynamic. Rob was front and center creating the flow of funds that spoke to this and other aspects that were not observable maybe on the regular Bloomberg screen. So the reason I have capital allocation up here is because Rob has started a new blog that speaks to capital allocation about AI and how to make decisions. And a mutual friend of ours, Rob, Mike Mobison from Credit Suisse, just released something after you wrote about him. So I thought it was neat to pull this up about capital allocation. And that's everything. Who's the best capital allocator? They should get the ability to make the decisions. And I think what we are talking about here is about incorporating a new agent, a new allocator, or a new tool. And that's AI in the process. All right. I don't know if you want to put me off sides or on sides about that assertion about what you do for a living, Rob, before I dive into the scorecard.
No, that's fine. Thank you. Just on the capital allocation side, I was writing down is most people think of capital allocation as financial capital. And I think what I've been focusing on more recently with AI Investor is the human capital and the process of investing and where you allocate across there.
Got it. And so, one thing that Bill often talks about is when he's investing in his companies, he's trying to find people who are able to lift, I don't know what we're going to call it, meat sacks or real people to their higher, better purpose. And by using AI agents, we call them terminators or, mechanical or silicon agents, put them beneath you and lift you up. So I don't know if that's sort of part of it as well. when you're talking about people and processes.
Absolutely. For me, it's kind of my personal tagline when I approach all of this is AI, like any technology, is a means to an investing in. I've always come at it from value capture working back. And in our business, value capture is investment returns.
Okay. Well, I'm going to go in here and rip through the markets because we usually like to have that macro backdrop for our subscribers. So this is the year-to-date look. Nothing new here, and it definitely hides what's been happening recently below the covers. Gold's still up, biggest 6-month move in the beginning of the year since 1973, and we know 70s were a disruptive period. Oil down, really orchestrated by the tariff move with Trump, and we'll talk about his new move with the government shutdown, whether that was orchestrated, allowed, or invited. But November is different. Bill talked about rotations or value going up. Absolutely. And we're going to talk about how that's related to rates, I believe. So here's that year-to-date move. We talked about Bitcoin down, up this morning, all over the place. That's more of a longer-term trade. We think there's noise in the short end, but there's definitely a shift here, a little bit of noise. Mag 7 all over the map. Meta comes out with earnings. People didn't like it. We just remind people that given he's going to put $100 billion plus probably in the next few years into AI, people sold off on that news. The last time we saw that was in 2021 when he said, I'm going to go deep into AI and Meta, and his stock went down over 70% over the next couple months. If you bought that dip, you made 60% annualized over the last 4 years. I see no reason why buy the dip is off the table now for reasons we'll chat about. But Mag 7 definitely taking a hit versus its long year-to-date trend. And now here's the factors. Factors, folks, are another way of looking at it. You don't look at ExxonMobil as a energy sector. You look at it as a hard asset play. It might be a value play, based on its balance sheet or its PE ratio, et cetera. So those names have done better in November, reversing what we've seen in October and year to date, and certainly over the last 10 years. So the question I have to the group here later on is, will value ever be able to overtake momentum or large cap tech, or the trend we've seen in the last 10 years? So we're going to go through that. This is where I want to finish on, because it speaks to, I don't want to speak for Rob specifically, but what I loved when Rob was a tutor, running a couple of businesses, but the one I remember was the flow of funds. Rob, is that what you'd call it?
Yeah. My partner and I did that.
So you would look at globally all of the asset classes. I'm going to let you finish. So what I do is, being from the credit side, I was at Credit Suisse and I saw the funding issue even before that when I was a head risk officer at a hedge fund during '08. And we saw that, wait a minute, the credit really makes this system run. David Rosenberg, who was, I think, at BlackRock at the time, he still is, he said, America runs on credit, riffing off the Dunkin' Donuts line. And he's dead on. And the government said, we can't have credit stop. And they doubled down. Well, right now, the government, with the shutdown, is causing a seizure in government spending. And you're looking at the Treasury's piggy bank get all filled up at the Fed to almost $1 trillion, the largest since the 2020 COVID crisis, when they just couldn't spend it quick enough. And they eventually put all their funding back into the market, and that's why we had inflation. So this is capital being raised and not distributed at a very sort of quick rate out of the system. And it's causing, this is the overnight funds rate secured, it's causing the cost of money to rise. People can't find money. And here you're looking at overnight repo facilities, which is the Fed injecting cash into the system, buying securities at a rate that we haven't seen since COVID. This is a longer term view of that. So there's a potential seizure, definitely a stress in the banking system. I'm not going to say it's going to crack, but if it's not addressed, I think definitely by Thanksgiving, we will have a sell-off. And that's why I think the government shutdown will be taken care of well before Thanksgiving, maybe for political reasons, so everyone can go to their table without being stuck in an airport. But the only relevance, I would say, for our discussions, I don't know if you guys want to talk about 2019, Rob, or other periods when there's a rate dislocation, that's also when behaviors change. Correlations go to one, or there are rotations. So I don't know if either of you can speak to that before we dive deep into what Rob's doing.
Well, jump in more with a question. than an answer. And that is interested in your thoughts around the transition mechanism to those kind of source liquidity dislocations and the markets. Because when we were doing the flow of funds at Tudor, the whole exercise was effectively to we were doing this. Paul Tudor Jones was our sponsor, and he was really the guiding light that pushed all of this. Started his career very successfully as a forex trader, and then moved upstairs. As the markets got bigger and bigger, it became much more difficult to be able to basically see the whites of people's eyes that were participating. And so what we did was effectively rebuild that sense of intelligence. So it was very market specific, very agent specific, our work, in contrast to what you're talking about now, which is very macro systemic.
Yes.
And in over 20 years doing this, I never really felt comfortable that I understood that transmission mechanism, the crossover point. So I'm really curious or interested to hear your thoughts.
So and that's dead on. And the broad macro dynamic would be, I'll go to September of 19. I was at Credit Suisse, and in August, this guy named Zoltan Pozar, who was effectively a Fed watcher. Yeah, remember Zoltan? And he worked at the Fed for a while, and he developed his flow of funds about how the Fed worked and provided assets to the system. He wrote something in August of 19 that caught my eye, because I also noticed that when there was a rate spike or pressure, there was always a factor rotation. My business was to help provide sentiment data to hedge funds, and I noticed that there was always that rotation. So I called it the entanglement of rates and equities. So I didn't know the mechanism, but I knew the outcome.
Yep.
So that's where I came from it, and I didn't see why that would be disrupted. And when I read Zoltan's piece, and maybe this will answer your question about the mechanism, JP Morgan said, you know what? If you're going to hit me with capital charges, because I'm a SIFI and I got to put up more capital, I'm going to take $325 billion of capital that supports the repo market, which is now a very low margin business, and I'm going to go home. Good luck. And I called Zoltan. I'm like, that sounds like a big deal, because repo, that's a levered play. That's a lot of capital used to fund billions of overnight money, hundreds of billions. And he said, I think it's a big deal. So we had a conference call in early September, and we had the hedge funds on. They kind of listened. And sure enough, as we know, on like September 5th, 6th, 7th, 8th, the repo market seized up. JP Morgan took their capital home. No one could fund, and it broke 10%, and the Fed had to come in and create a new facility. So the mechanism, I think, is that when you reduce capital and overnight, things seize up, and capital mortgages stopped. The other looser segment, Rob, is that even before you get to that seizure, if there isn't enough balance sheet and capital, banks can't execute capital market functioning, and that includes rolling debt. We say 20 years ago in capital markets, 60% of the activity was just refinancing debt, rolling debt. Now it's 80%, close to 80. So when there's a reduced capital base and people can't get funding, they can't let Johnson & Johnson roll their debt. They can't let people feed. So then activity can be reduced. So I haven't done a great job of showing the exact mechanism, but that's the order of operations on the stressor. And yes, you can't trade that. You can't show that dynamic to your boss and say, trade this today at 9. You're right.
I'll just jump in and add it. I think that was the last straw in the global financial crisis. Finally Goldman Sachs and Morgan Stanley couldn't do. Yeah, I didn't realize it's 80% now either.
77, yep. Isn't that crazy?
I guess it makes perfect sense since we've been watching this happen in slow motion for a while. But yeah, that's pretty crazy stuff. I hope they're making enough money doing that.
Yeah, they're eating okay. So, Rob, I would love to go back again. People love war stories, but is there an analog? Because it sounds like exactly what you're doing is what you did, as you said, when your boss couldn't see the whites of the information from the whites of the eyes. So he had to do an extension of what was a pure analog experience to get information and win.
I mean, I guess and this is like kind of a bit of a perhaps reach, but it's what you're doing, like how I'm thinking about AI and investing, again, as a means of return, might be similar to what we did with the flow of funds, where you have to start off with kind of a framework understanding. Because whether you're doing, trying to incorporate AI or you're trading markets, you're starting with an infinite search space. And without any structure, without any roadmap, you'll just end up wandering all over the place and getting completely lost. And I'd say that's probably, if the mechanical work of what I was doing, or maybe even the more abstract work with flow of funds, back then to what we're doing now, what I'm doing now, that would be the connection. I
So
might,
you're saying that the equivalent of using an AI prompt to discover opportunity is the equivalent of a person death scrolling on Twitter or X because you don't have a purpose, a framework in order to land the plane or know when you've arrived.
yeah, a very similar risk.
Not that I've done that. Not that I've death scrolled anytime.
Well, I mean, going off on a tangent, doing that kind of experimentation now is important to the point of being critical. But that's kind of almost the difference between the prototyping stage and production. And if you're going to go to production, you really need to have a clear idea of your process, understanding your inputs, how you then process those inputs, the outputs. You need a very clear idea of what good looks like.
Mm-hmm.
And that's the same conceptually, whether we're talking how you're risking capital or how you're incorporating this new technology in that process.
Well, I saw that footprint of structure in one of your recent blogs where, I talked to you about it right before the call, where you state what you're going to talk about, and then you give a little bit of blurbs ahead of time. And was it the observation in the text? So you gave source data, you gave context for it, and then you gave your insight. And for anyone out there interested in a Reader's Digest of decades of experience on AI and players in it, you followed some pretty impressive people, Fabozzi Mobison. I suggest reading that from Tutor to Just or Kensho or what you're doing now. Can you walk across that pond of career stepping stones for us to say how you got to that? Because that's my favorite part of your blog, are those steps. I love it. I feel like it's a distilled intelligence.
Well, thank you. I might, I'll try to keep this quick. Is I'll even go back even further. So it was like the summer, between my junior and senior year in school, I had an opportunity to work at a stock brokerage firm back in Southern California. I walk in, they asked me if I knew how to use a computer. I bluffed it and said yes. At a Fortran class my freshman year. Sit down, working for two guys, one of whom had an IBM XT, a floppy drive, and a 10 megabyte hard drive, and a bootleg copy of Lotus 123.
Taking a beat from the podcast to talk about our sponsor, Unchained. They're the leader in collaborative multi-sig custody. What that means for Bitcoin is that they're the leader. They've been around the longest, 10 years. They have over 12 billion in Bitcoin. That's about 1 in every 200. The reason I use them, because I know Bitcoin is collateral. If you own the ETF, and I have owned the ETF, you don't own Bitcoin. You don't own its potential going forwards. Look at the show notes for the link and use our code of NewBarbPod10 for a 10% discount. Again, it's Unchained. Back to the podcast.
And I was literally going from that transition point of using paper calculator to using technology spreadsheets. And I would argue none of us would have what we have if it wasn't for the simple spreadsheet. But that was the beginning of a whole career of being very market obsessed, but using data and technology to move around obstacles and just get to wherever I wanted to be. And that's the through line that I took into Tutor. We were very much a build versus buy shop. I landed there at just the right time where they were building out their own scripting language. So for people who, think of Python before Python, wrote hundreds of thousands of lines of code, built apps and everything else. But again, it was coming at it from the front office side. It's like, you need capabilities, look around, grab it. Go to Kensho to run products, sort of being our former self. Kensho was an AI-centric fintech, different kind of AI than what we're talking about now with the large language models, more machine learning, things like that. And then spent a few years at the nonprofit Just Capital that you mentioned. Very similar Just Capital Tutor, flow of funds framework, building out and supporting more of a ESG type framework of responsibilities. And then, ending my time there, the last year, there was a lot of focus on how to operationalize AI and also how to judge ethical or moral usage of AI by companies. Going through that experience, I'm like, I need to get my hands dirty in a market sense. That's my expertise. That's where I know. I'm a visceral learner. And so that's when I left there and started another blog, where every night I go through and review the biggest moves of the day, use AI to fetch the text and do the judgments and everything else.
So when I went through the macro, if the readers or the listeners and I can understand why you said, okay, now show me how that observation mark is actionable. Show me the mechanism where that TGA going up to $1 trillion means that value stocks will rotate, means that Exxon will outperform Meta, and et cetera. And that takes, as you've a much bigger build and a much more robust framework. I did the easier 5,000 foot or 20,000 foot view and observed, I guess, relationships that followed, but no data and no hard causation other than, I won't say theoretical, than structural relationships, but without the data. So it is, I still think the commitment to do what you did at Tutor is huge. And I don't know, Bill, if in your experience you saw similar uses of data, but not for macro, that tried to bridge that gap from observation to action.
Yeah, I actually liked the way, Rob, you described sitting above the floor and looking at the whites of their eyes. That is how things were done in the past. You would observe human behavior and people running around, and like one pit would get loud, and that would tell you a lot. And so in the ivory tower of quant research, that is the most silent place on Wall Street. Especially when I joined my last employer, like everyone just had headphones on and they would be typing away. And most of them are coding in, like you said, legacy languages before Python. And so that required even more concentration and more silence. So when we were building out, a flows data set, what we were trying to do is emulate what you just described.
Yeah.
And I loved how you described it that way, because it didn't even occur to us like that's what we were trying to emulate. We could see in the data that flows around the world into different stock markets and assets told us something. But we would go to people like Mark and our contacts at the prime brokers and oftentimes like have these interviews with street operators who had that experience, and we'd sit there and like take all the notes down and then go back and try and emulate the humans, or at least validate that what we saw in the data. But we were coming at it from data first, and then you would turn that into a hypothesis driven workflow, so you could have like a linear forecasting model from that data. And it was all the same sort of thing. I think we were ultimately trying to figure out what the people on the floor would have been doing if that was still the way things worked.
It's a core insight or premise principle. I always get those all mixed up. But as data at the end of the day is a proxy, the measurement, it's a proxy of
Yeah.
behavior, a state, or the like. And a lot of times people with their headphones get on, forget that. They think the
Or never
data,
or never knew in the first place.
yeah, or it's, they think it's just, it's life itself. It is what it's the thing. It's not a thing. It's a reflection
Right.
of it, perhaps.
Simulacra.
One distinction, as you mentioned, the linear
Yep.
is the way Paul always traded. I described as the tails is a very nonlinear space, and the humans, that's the human dynamic is not what's taking place in between what plus or minus one standard deviation. It's what's taking place on the outside.
Right. So now we're getting into my favorite speech when we're talking about fat tails and when Aaron Brown was on, it was a kurtotic distribution. When I started doing quant research, a lot of what I was doing was bringing the fundamental angle into quant. And so a lot of times a quant would come by and they'd say, what's wrong with this industry or subsector or region or this particular company, and you would go off and look at what this outlier was telling you. Most quants will not most quants, many quants will actually clip those observations from their data, clip or kind of trim them off to make sure that they have an accurate representation of the purely linear factor. But if you don't investigate the outliers and then look at them and hopefully classify them as type 1 and type 2 errors, so understand when your model is right, when it could have been when your model is wrong and it could have been right, is a very important label to add because like those are real observations obviously, and when that fat tail hits, like you want to know, and these are like, the canary in the coal mine. They're just more rare observations, but they're real, and they can certainly be, an indicator of a shift. And that's why I guess my former boss at AQR and I, were criticizing a few weeks ago how quants may, what did he say? He said torture and massage the data so much that it's no longer meaningful. But yeah, the fat tails, and I would think a discretionary, a macro discretionary type of investor loves to see that. They're like, oh, everyone's behaving irrationally temporarily. Let's put that trade on right now. And, if you can do it systematically, that's how you would do it. It's always like, look at the 2 or 3 standard deviations. I just mentioned there were some big ones. I think that, and then you get into this type 1, type 2 thing, right? So we've had this crazy rally in tech and now things are reversing a bit. Is it really that crazy, or is it, more of a return to normality? And, that's where the judgment comes in. And hopefully we can train the AI agents to think more like humans, but it takes a lot of work. And for me to be confident that they're able to make these distinctions is going to take a long time.
Well, yeah, and a couple thoughts came to mind while I was just listening to you. One is at the when tail events, sometimes are truly random, but
Yep.
often enough, that's where I've learned the most about a system is when you're at a tail. And this for me is pure conjecture, but that in between plus or minus 1 standard deviation behavior bounces around is fairly random. When stressed, the system becomes more predictable.
It's
Right.
like a person, Rob. You really find out about a person's character when the shit hits the fan or times get tough.
Absolutely.
So I love that you just laid that up there about a system. So you focused on the tails.
Absolutely. And certainly we were also we were discretionary. And my partner and I, we were part of a group, Synergy, that tried to blend the best of discretion and quant. We were a little early given what the technology is available to. But I want to go back to, the tails and understanding and the macro and kind of draw, where does AI possibly fit in with that? One, tend to be more nonlinear in your observations, but where my mind was really going, and I'm thinking back to a conversation Michael Mobson and I were having around this, is the ability to curate an audit trail or a sense of memory of the process. Because there was a lot of insights that we made and lost along the way because you're in the middle of it. And it's hard, and you're not writing notes down, and you're not recording conversation. Well, unless maybe you're at Bridgewater, you're not recording everything that happens along the way. And now we're getting to a world where you could start doing that. And I think the feedback, the compounding of understanding that we'll be able to build, and benefit from on our side is going to be pretty fascinating.
So it's the richness of the tail that is probably, I call it a coiled spring. I'm not unique in that. But are you saying to look at those moments and audit them, whereas a quant may throw them out as atypical, a macro manager goes into it with a mining helmet and a pick and axe to say, what else can I find?
Understanding just what you've been doing all along and building a memory of that. So the next time it happens,
Right.
you have
And
that
so,
learning and understanding.
yeah, a few things to add here. When interviewing candidates for the risk management job, a lot of times you would try and test them and see how are they going to operate under pressure. Are they going to panic? Are they going to just close down? Because you can't have that in that environment. You have to be able to operate, make decisions, but also, if you're keeping track of your decisions and the reasons why you chose this or that, and then later on you can test, was I right, wrong, why? Quant speak, and then I think AI speak, a lot of this is called labeling. You label these different decisions. So any fork in the road, you want to say like A or B, why did you choose A or B? And then later on you can say, was was I right or wrong? Earlier, when we were just talking about the non-linearity of these fat tails, that's where machine learning and nonlinear predictors become super valuable, right? So you have this linear process, like two things always behave similarly, and then all of a sudden they don't. If you can ever get good at predicting when that's going to happen and when it's going to be real, then you can make a ton of money because you can, beat everyone to the chase. And so what would I do with that backward looking information? So I have all this metadata around a process and I find a nonlinear predictor for that thing. So a lot of times it can be a news based update. So, an announcement, Trump announces tariffs. Like that's probably not a great example of something that repeats over time, but a nonlinear predictor that shifts the linear process is called a reversal factor. And, it's kind of the crown jewel, I think, in systematic investing, where you could really approximate that human that has been around for a long time and knows exactly how to react when the last time they saw, everyone panicking in that one corner of the floor. I don't want to get back to like a trading places analogy, but like all of a sudden you're like, buy, 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 after everyone's sold and you want to like pick up that dip. I would think, yeah, discretionary managers and humans are always going to be better at that and being confident about that. I shouldn't say always. Someday, maybe not. But until we're all gone, I'm going to say we still have a lot of good experience from back in the day.
Well, it's the intuition that identifies the exception is the way I've described it. I think it's, again, if we can start kind of recording that intuition, memorializing it in such a way, you then have it spinning in the background and kind of as a century almost, looking for, well, we're starting to see some of these things and here's the connections and here's the logical consistency.
There you go. Yeah. Logical consistency is probably, ultimately these labels and sort of pieces of information that start adding up to the right thing. And you can have a human go back and say, yes, this AI has organized this data appropriately. It's logically consistent with my intuition. That makes perfect sense to me too.
So when you guys are talking about that, archiving the data and examining and then applying our intuition, there's by labeling, there's a term I call masking, or it's called masking, where, AAA bonds weren't AAA anymore in '08. The repo facility was no longer the repo facility because something out of sight changed. JP Morgan pulled their money. So the reliance of overnight funding went away, but no one gave the public order. So when you look at systems, or let's go back to what you said earlier, Rob, as we were joining, it's ever more critical to have someone who has a liberal arts education, which is broad, thematic, or I don't know how you want to describe a liberal arts education, classically trained in logic and maybe non-quantitative approaches. Is there, when you have that body of knowledge that you've archived, when you're talking to Mobus and you've audited it and you bring it forward, do you consistently examine to say, oh, it looks like it's the same, but in the last 6 months, AAA is no longer AAA. We have to adjust it ourselves. Like, do you do that how do you do that? Like update the data that you have stored because a neighborhood is no longer the same value because things have changed. It's got terrible curbside gas service or a school left, things like that.
Sometimes you just don't until after the fact, and then you keep a note for the next time. But I'll bring it back to a way I used to talk about the flow of funds a lot. So flow of funds, supply demand analysis. And oftentimes when one first starts talking about that framework, that approach, they think of flows as an engine. So it's the buying and selling that drives price. And we came to interpret it as two things. There's a duality. Sometimes it's an engine. Frankly, more often than not, it's a transmission mechanism. And so for any given catalyst, depending on how the institutional setup is, sometimes price will go up, sometimes price will go down. And the example I always used is if you saw a 3 standard deviation move up, I would interpret it differently if that came after a 3-year downtrend where all positioning is completely rinsed out, investors are underweight, and you have 3 standard deviation move up, new management or something like that. You're like, okay, I'll interpret it one way. Whereas if it happens, 3 standard deviation move up. After you're in NVIDIA today, you're kind of like, when I first got to Tutor, it was to build out price-based trading systems. So think of old world CTA type stuff. Trend following, shockingly, was, kind of core to what
Mhm.
I was working on. And I remember, if I had a holy grail, if I knew for sure if I'm in a trending regime, I'd have a much tighter, trailing stop and everything else. If I'm in a choppy market, you have a much wider. But
Yeah.
back then, you just kind of tried to find some balance that would work across the same set of rules that would work across all regimes. I'm like, God, if I could just, or you're using a football analogy, is it a passing down or a running down?
Right.
How much easier would it be to, put the players on the field? And then, and something that kind of I came to appreciate more later when we were doing the flow stuff, is the real holy grail is the regime identification change. When's the regime going to change? When is your demand curve going to be normally sloped where people sell higher prices, buy lower prices, to all of a sudden market goes, sorry for the technical term, negative gamma, and higher prices beget more demand. Lower prices beget more selling. Cue up 2008, 2009.
Hmm.
These are the crown jewels of,
That's, I mean,
systematic research. And I like how you brought it back to CTA too, because, trend following and momentum are scary beasts to try and stand in front of if you're wrong. And, but if you're right, you can rake in the money if you ever know, if you have just confidence that like times are normal, you could make a ton of money. So those are
if you could identify when the 14-day moving average is the smartest person in the room,
So that, Rob, what you just laid up there on Bill's point is, I want you to go back to your point about how to use AI, how you're using it in your writings, and how people can get in touch with you, because we're running up against our time here. And what you've done, as I said, is just, it's like a capstone on decades of work, and it's live and in color for people to look at. And about a third of our audience are like younger. We call them
careful.
some in college, some in that sort of sub 30-year-old. I think I need to make a career change. I'm not sure the ship is going to continue down this path, and they're kind of bummed. Some of them are bummed out. How would you talk to them equivalent to your junior, senior year, maybe, or how the opportunity is?
I have 3 sons, aged 23 to 27.
That's right.
And the oldest is, he's a software engineer. Actually, is going back to business school. I tell all of them, this is not one of the very few opportunities where someone under 30 can be viewed as the smartest person in the room. And back in the day, I remember, if you ever try to guide parents or anything through using the PC early days, you're afraid to hit return. You're like, you're going to nuke everything. But you look at the young kid who says, yeah, I know computers, and you'll trust them. So to me, it's an incredible opportunity to have a voice at a table. Too, I literally would not be here today without having the insight that technology empowered me. It wasn't a threat. It was a way for me. I joke, I don't know if I've been in another meeting in my whole career with someone else who went to junior college. I joke it let me, compete against the Ivy League. It's such it gives you agency. It really does.
It's awesome. We've seen that, Bill, I go back to Charlie a lot. And then we had a guest on a few weeks ago who said, I don't need college kids. I need people who are willing to work, understand the new technology, and can help me go.
Yeah, but hopefully that is college kids, because the big risk is we don't train that next generation. And I think we're being companies are being very penny wise, pound foolish.
And when you say train, you're also talking about that broader aspect, that how to learn to
How to learn to learn, how to learn the essence of the business. You talk about, at the beginning where you're talking about certain macro considerations at a high level without the underlying data. This business is always, and most businesses are always going to be talking at a high level. Now, you trust those observations, those judgments, if the person has a very deep micro understanding bottoms up. You don't swim in that every day, because otherwise we wouldn't get anywhere.
Right.
But you need to train. And you need to train the next generation. You just do. I think we have a moral obligation. I think it's a commercial obligation as well.
Yeah.
But you mentioned, where can people find me? aiinvestor.co. So aiinvestor.co. That's where I've got I publish every week, sometimes every month now, depending who I'm able to access when I'm talking about AI as an investor. You can also link there to Big Moves. That's the one I started, a couple of years ago. So I could both get back involved in the markets on a daily basis, and also experience the highs and lows as a user.
Yeah. Yep. It gets you in real time with real time data, like exploring tails, like you said, where all the data is. Well, this has been awesome, Rob. As I said, guys, when Rob says train people, get out there, it is our responsibility as seasoned people to do it either explicitly through your job or otherwise. And the other part is see people in real life. We sat around tables together, talked about business, our families, we got to know each other. And here we are years later, in another career, still talking. So get out there and have fun, folks.
Well, Mark, thank you very much. It's been a treat. Bill, pleasure seeing you again.
You bet.
Thanks, Rob.
Thanks all.
Take care.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support.